Today, getting deeper into our data. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. So I had quite a few people subscribe to get the latest DFA data set and specifically the projections on home price movements for the next 3 years via our Patreon program. But I had a few questions being posed by people who grabbed that data. So today I'm going to go into a little bit more detail about how we get the data and specifically what the information within the spreadsheets that are available mean. To start that, then, let's just remind you that we're pulling information from our core market model, and that core market model is effectively a simulation of the Australian economy, specifically focused on the property sector and households. And the information comes in from our rolling household surveys, 52,000 at any one time. That's just over 4,500 each month. And we pull information from a whole range of other sources. And by the way, we also make sure that the total debt outstanding sums to the total as reported by the Reserve Bank, and the total household profiles align to the latest ABS census data. So those two anchor points ensures that overall the information sets are actually accurate. We then run a whole series of queries through our core market model, and those queries allows us to then make further analysis. Now, one of the things that we do is to slice and dice the data multiple ways, and as I've explained on several occasions, this is to do with being able to turn the elements within a Rubik's Cube to look at it in terms of property owners versus those who are not, particular areas, particular postcodes, those who own property and those who don't, particular segments as well, and it's very important to understand that those segments are deliberately designed to be mutually exclusive from each other. So, for example, if you are a young growing family, then you're not going to be a battler necessarily. And if you're a self-funded retiree, then you're not going to be in the disadvantaged fringe group. The reason for doing this is to try and understand the dynamics around different household segment groups. And we can also, of course, cut it through states, different geo-mapping locations around centres like CBD fringe, inner suburbs, outer suburbs, etc. And also where people are on the property purchasing hierarchy, from wanting to buy through to first-time buyers, through to people who are refinancing or property investors. Now that gives us a lot of richness in the underlying data that we hold. And overall, this is a 0.5% sample of the Australian population, which is then grossed up to equal the Australian population. Now, the core market model also then allows us to think about some scenarios, and scenarios are effectively potential futures. In other words, how is the economy going to perform ahead, and what will the implications be? Now, the scenarios allow us to take account of multiple factors, including things like the Reserve Bank's cash rate, unemployment, broader economic growth factors, as well as the fiscal and monetary settings that are being applied. And we then can make some estimations about how that may play out with regard to home prices, but taking account of our mortgage stress information, the price trajectory history information, the buying and selling intentions from our surveys at a granular level, as well as migration, which is important, of course, particularly as there's a net negative migration coming on at the moment, as well as the CPI, wages, unemployment. All of that then flows through our core market model, and that allows us then to model prices down at a postcode level, as well as rolling it up to a state, region, and all Australian level. Now, that much I've explained a few times before, and of course we'll do it again because it's pretty important that people understand how we do our modelling. Now, to get access to my data, there are a couple of ways. The first is you can contact me directly, and I'm happy to provide a high-level summary at a postcode level, and here is an example. But if you want a more detailed deep dive into a particular suburb, or even to the postcode level, then I can do specific research for you using my model and other sources, and that's our DFA one-to-one service. And in that service, it's basically a confidential discussion with me. I can't give financial advice, but I can certainly share the deep data that I have from my models. And that means I look at stress, home price trend data, and also trends ahead based on my modelling, as I've explained through the scenarios. Now, to do that, we do it normally by phone or Zoom. Zoom is probably better because I can share my screen, and the conversation can be up to an hour in length, and it normally takes me about half a day to do the research. So it's a reasonable amount of effort to put the information together. Therefore, I do charge a fee for doing that because I just try to cover my costs, not making a profit, but I am trying to make sure that I come out roughly flat at the end of the exercise. And if you are interested, you can contact me via my blog. Spaces are limited each week, and I'm booking somewhere between 3 and 5 weeks ahead at the moment based on the demand that I've got. Now, the third way to access the information is to access the data set which is available by our Patreon. And there's a special offer on at the moment where people can get not only the stress data down at a postcode level, but also the projections with regard to where prices may be moving over the next 3 years. So that's a special on. In fact, the way it's going to work is that those who subscribe during January will get the information for January, and if they continue to subscribe, I will also send out the detailed information in terms of price movements in February as well, because there are so many moving parts going on at the moment. So that's $50 US, and you can go to Patreon and sign up for it. But now the question becomes, so what do I get if I subscribe? And what does the information mean? Well, there are 2 sheets to the spreadsheet. One of them is the trend chart, and that allows you to put in any particular postcode. I don't know, let's put in Rushcutters Bay 2011, which includes Woolloomooloo, Elizabeth Bay, Potts Point, Rushcutters Bay. And that then brings us the information with regard to our 3 scenarios, best, mid, and worst case. And we look at 12 months, 24 months, and 36 months from the end of December. And we can also look at the information in terms of houses and also units. And as you might expect, there are considerable divergences between the best case, which essentially assumes that the virus gets under control quickly, the borders reopen, and the economy booms. The mid case, which is perhaps a little less aggressive in terms of response to the virus, and also an assumption that there will be more outbreaks ahead. And the worst case scenario, which is that things continue to deteriorate, as, for example, we've seen in the US and in the UK. And there are profound differences in outcome in terms of home prices in those 3 scenarios. So that's the first part of the information. And that, by the way, is the new information, which is available as a special in January. Now, the other spreadsheet, which I've made larger here, just to make it easier to see, is the structure of the rest of the spreadsheet, the data page. Now I'm going to walk across each column and just briefly explain what each column means. Some will need very little explanation, others a little more. So we start with the postcode, which is pretty obvious. That is the base data level at which the information is reported. Then we move to the number of households estimated to live in that postcode. I work at the household level, not the individual level. And then I look at the number who are borrowing, the number who are renting. Now that's based on our surveys and is cross-correlated back to the census. Then I look at mortgage stress firstly. Now, our stress series makes an assumption about cash flow. We look at money in, money out. Are households earning enough, generating enough income to cover all their outgoings, including their mortgages? And we set the boundaries between not stressed and stressed at just above zero and into minor negative territory for mild mortgage stress. And if the deficit is more than 5%, then they're in severe mortgage stress. So column E is the number of households in this particular postcode in mild mortgage stress. In other words, they have cash flow issues. Now, it's worth, of course, noting that just because they have cash flow issues doesn't necessarily mean they've got immediate issues. They may have, for example, access to credit cards or other forms of credit, or they may indeed have deposit accounts. But nevertheless, over the long term, if there is a cash flow deficit, it tends to lead to issues. Those in severe stress in column F have more significant immediate issues and generally are forced ultimately to either refinance or maybe even sell their property. We then sum those two columns together in column G, so all stress relates to those in mortgage stress. So in postcode 810, we have no households who are in severe stress. They're all in mild stress. But if we go down the sheet to postcode 2000, we can see there that we've got 316 in mild mortgage stress, a further 306 in severe stress, so the total mortgage stress count for that postcode is 622. Then we do the same calculation for rental stress. Now, these are households who are renting, and again, it's the same question. Do they have sufficient cash flow to cover their rents? And we use a similar series of cut-offs there as well. So if you go into negative territory, you are in stress. And we are seeing, as I've reported quite recently, rises in rental stress. Now, I'm going to leave financial stress until later, but column J, K, and L are all to do with mortgage stress. It's the percentages of households in a particular postcode in mortgage stress, both at the mild and severe level, and total mortgage stress is the combination of the two. So in postcode 810, 26.5% of households are in mortgage stress. And we do the same calculation for rental stress. That's the proportion of households renting who are in difficulty. And then we have some basic information as to the state that that particular postcode is in, a short location, which is not meant to be inclusive, but just indicative. Then we have a district. Then I also flag it with a regional code based on my own definitions, and the segment that they're in based on the DFA segments, as I discussed earlier on. Then we move over to the investment property segment. And here we're looking at the number of investment properties in the particular postcode based on our surveys, and also the number of property investors in the postcode in our surveys. Now, to be clear, investment properties counts the number of investment properties in that particular postcode. The number of property investors is where the property investor actually lives. And you can't necessarily correlate column T and column U because they're looking at it from two different dimensions. But I then assess the stress of property investors, and we apply the same basic methodology once again. Are they cash flow positive or are they cash flow negative? But I also include algorithms to take account of the fact that the property may be vacant at the moment, that they may be trying to sell the property at the moment, and other factors to make the analysis meaningful. And I also have the same definition, so severely stressed investors mean that on at least two dimensions they are severely underwater. Stressed investors may decide to continue maintaining their investment property. Severely stressed investors are much closer to deciding to sell, or indeed have actively put their property on the market, or will so shortly. Then we have the percentage of investors stressed, and then I have some further information about the specific location. This is called the long location. And this is the definitive range of all the suburbs within the postcode. Then I have some data on risk of default. And risk of default relates to the mortgage element. And it's based on my projections of what I've seen over the last few years, taking account of information that I have from all sorts of sources, including loan portfolios I've analysed for a number of lenders. So that gives us both the number risking default and also a percentage figure. Now, in the next few columns, we then have our movement projections. And we have a baseline view of 12 months, 24 months, and 36 months. 12 months, 24 months, 36 months for the high one, and 12 months, 24 months, and 36 months for the low one. Now that is aggregated to the postcode level. And then we have it broken into house and unit. The house level, 12 months, 24 months, 36 months. And the units, 12 months, 24 and 36 months. Now that's based on our mid case. And then the low case is 12 months, 24 months, 36 months for the house. And units, the low case, 12 months, 24 months, 36 months. And then we have the high case. And as I've explained, it's based on our different scenarios. House 24, house 36, and unit 12, 24, 36. That information is precisely what is ported through to the spreadsheet that I showed you earlier on, which is where we display that information in a way that's more meaningful. And I should underscore that these are cumulative movements over the 3 years. So if you want to understand the incremental movements, you need to subtract one from another. Then I've put some further levels of granularity about the location and also their remoteness based on the standard Australian statistical database. And then I need to come back to financial stress, because financial stress is an aggregate measure at a postcode level, taking account of all households and those who are in mortgage stress, rental stress, or investor stress. And it's a little bit complicated because, of course, potentially you might be in more than one category. But nevertheless, we have there the count of those in financial stress, and in column N, the percentage of households in financial stress. And I do find that the financial stress percentage indicator is very powerful when it comes to, for example, expectations with regard to future price movements. And when I look at those projections of my movements in the different scenarios, I use the financial stress metric, the rental stress metric, and the mortgage stress metric as key drivers of the expectations of prices, along with the other information that I described earlier. So there you are. That's a quick walkthrough of the data set that's available now. So you can go across to Patreon and sign up to get the data set. And I should say that I will be sending out the same information next month to those who've signed up via Patreon. So you will get the revised movements as I project them next month as well. And those who signed up to the $50 Patreon level will be the first in the queue to get access to our full online tool, which is in final development at the moment, and will provide all of the same information and a lot more available to those who have signed up already. So we'll be sending out emails to those at this tier level when that information is available, probably within the next month or so, but we're just making some final changes and doing some final testing before the tool is fully available. So I hope that was a useful walk through our data set and some of our underlying assumptions. If you've got more questions, put them in the comments below and I will try to answer them. And just a quick reminder that on Tuesday, I'll be running my next live stream. And on that live stream, I'll be taking our analysis further by looking at some of the geo-mapping that we also do, because once we've got the granular data there, and also our confidence data, for example, and indeed our investment performance data, we can also geo-map it. And that shows you where the hotspots and cool spots are. And that, of course, has a very interesting relationship to prospective price movements ahead. So mark your diaries and join us on Tuesday at 8 p.m. Sydney time for our next live event. I look forward to seeing you then. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.